Hello, everyone. Welcome to another episode of The Sense of Things. And this week, a second episode of The Sense of Things, because we had so much stuff to talk about. It was just a bit of a crazy week. Hang on just a second. This show, we're going to focus on the One Big Beautiful Bill Act for business now. Last week's show, we covered some of the effects for individuals and what it means to you. This week, we're going to focus on what it means for business, and I'm going to run this show this week. So stay tuned. We'll be right back on in just 1 second. Hey, everybody. Welcome to the show. Ron, how you doing, bud?
Good morning. Good morning. I'm excited to hear what you have to say about the One Big Beautiful Bill because I know we could keep analyzing it. What do you got?
And honestly, I'm going to have to keep analyzing it because as I even went through this very high level version of it, I realized, wow, there's a whole lot of little things that I need to focus on in here. And there were some things in this that I didn't even remotely know that had been in existence before. And I've been doing this a long time. Let's get started. Quite a bit of information that we're going to cover. Let me jump on here real quick. And okay, you should see that, correct?
Yes.
All right. Okay, so I really wanted to focus in this bill, everything from mom and pop, small business, all the way up to big, massive businesses. There's something in it for everyone in this, but what I wanted to do is really focus a little bit more on small and mid-sized businesses because that's likely who's listening to us. If you run a big business, that's great. And a lot of this will apply to you. But like I said, for the vast majority of businesses out there, we're all small and mid-sized businesses, and we have an understanding of what it means. So a couple of things. A lot of this bill made permanent the things that were in the TCJC of 2018. So the original Tax Cuts and Jobs Act was fantastic. It's really helped our economy over the last 8 years. But basically, all that was set to sunset at the end of this year. So with the Congress doing all this stuff, it made all of this stuff permanent. And one of the big ones is 20% qualified business income deduction for pass-throughs. So S corps, partnerships, sole proprietorships, your business income deduction is 20%, which is fantastic. And then that is permanent. So it's a planning thing that you know. The other piece of it, Section 179. So Section 179 just basically says if you put things into play in your business, especially with equipment heavy businesses. So let's say you run a earth moving business and you have to buy tractors and backhoes and things like that. It basically doubles the ability to expense those right away out of the gate. So it's a massive boost to cash flow for a lot of these businesses. However, and we'll talk about this on a slide a little bit down the road, it does phase out at $4 million and it can go away after a period of time. So something that we're going to want to keep an eye on. This, I think, is probably one of the coolest and most interesting parts of this bill. There's accelerated asset and R&D deductions. So here's the cool, what I consider the coolest part. It's Section 7301 of the bill, 100% bonus depreciation, immediate write-off for new and used equipment placed into service after January 19th, 2025. There's no phase down. It's fully permanent. So your business can deduct 100% of eligible asset costs in year one. Here's the cool part about this. If you're building a factory, you can 100% deduct that in the first year. Now, I don't know if I would do that from a real estate perspective. I'd probably depreciate the factory out, but all the stuff inside of it, but literally a business can do that. So what does that mean? That means a huge opportunity for people that are putting into place a production. This has to be a production facility. So it can't be like an office building. It has to be some kind of production facility. Office buildings that are part of that production facility and R&D that's part of that facility can be 100% bonus depreciated. The other thing is domestic R&D costs are now expensed immediately versus amortized. This is going to be huge for trying to onshore back a lot of the pharmaceutical stuff and things like that. A lot of the reason these companies took stuff offshore, one, it was cheaper, but two, they had this accelerated depreciation on a lot of the stuff, or accelerated amortization on a lot of this stuff on their R&D costs. So that is amazing. It's retroactive back to 2022. So a lot of really cool stuff. And this can go all the way down to small businesses. If you're putting into place software to make your business better, that can be considered R&D expenses and things like that. So a lot of work. You're going to need to work with your tax advisor on a lot of this stuff. This was something I knew nothing about, and I do exit strategy planning for clients all the time, and I didn't even know this was in existence, and now this new one is even better. So expanding qualified small business benefits. So gross asset limit increased from 50 to 75 million. For most of us, that wasn't a big deal. Exclusion caps were 10 to 15 million. Here's the big thing. This is section 70431. If you are considering selling your business, and it's stock sale, okay, which used to be like treated as ordinary income. So it really sucked. The big change, and this has been in effect for a while, but this is a beautiful thing. If you're doing a exit time or there's a tax-free exit timeline now. 50% tax-free gain if you've held a business or investment for 3 years or more. And this is small business type stuff. 75% if you held it for 4 years, for 5 years, it's 100%, meaning that is a tax-free exit without capital gains. Now, here's the cool part. For the vast majority of us who own really small businesses, it's even better, because if you make less than $400,000 per year and you sell your business in a stock sale, you have 100% regardless of the time of holding that business. So this is massive for people that are that wealth transfer that's happening, especially a lot for the baby boomers that are transitioning out of businesses. It is the time to spend some time working with an exit planner. This does not take effect until tax year 2020 or until 2026. So it's anything that happens after December 25th or December 31st, 2025 and goes into place. So if you're planning an exit from your business, you need to start planning as quickly as possible to do this, because this one does sunset away in a few years.
So hold on, go back to that for a second.
Yes, sir.
If you're a solopreneur or a partnership,
yep,
and you're a small business, maybe $1 million, $2 million business with employees,
yep,
you either have 100% or 50% of stock that
yep.
you sell, you could write it all off.
You don't write it off. You just don't have to pay capital gains tax on it when you sell it.
What's your max tax on that?
Max tax is, there is no tax on it, the sale of the business.
So if you get $1 million for the business, what taxes do you pay on it?
You don't.
Okay, that's the confirmation.
Yeah, that's it. And like I said, if your earnings from that business are less than 400,000, it doesn't matter how long you've held it. It's 100%,
Right.
which is just
that makes sense.
huge.
I just want to make sure that the small business owners fully understand that.
Yeah, and this helps. This also, this is what I call the farmer's subsidy more than anything, because it helps out farmers so much, because so many times they might transition a business to their kids, and if they die, I mean, it falls under estate tax planning, and they don't usually have a lot of cash on hand. So especially for smaller farms, and some of these with the exclusions up to 10, from 10 to 15 million at that point, there's some huge things that are going to help a lot of small family businesses not get just crushed in an asset sale, or not an asset sale, but a stock sale, which is usually the most inefficient way of doing it. Excuse me. This is another thing that was actually an incredible thing: more favorable interest rate deduction, or interest deduction. So used to be your interest was only deductible for EBIT Now it includes deductions for depreciation and amortization, which makes it much better if you need to finance a transition, if you need to finance something for business growth. This gives you a little bit more window of what you can do to make that more efficient from a tax standpoint. This is huge. This is another big piece that I wasn't really aware of in this piece that I mean, for a lot of businesses, especially small businesses, that's how things are financed, is going to be through the bank or whatever. And having that extra little bit of depreciation and amortization in there, if you've got real estate, if you've got property or equipment and stuff like that, this will be a benefit for a lot of those businesses. So here's another piece. And once again, I think for a lot of companies, or I was just listening to Representative Rokana this morning, and he was on the news and he was talking about we need to have federal government come in and step in and provide like $10 a day child care for people like this. The law actually put into place for businesses the ability to get, and if they provide employer provided child care, okay, let's say on site or working in a partnership with somebody, for general businesses, they get 40% of eligible expenses up to $500K. So if they're actually, and for small businesses, $30 million or less in revenue, 50% of expenses. So if they provide on-site childcare or something similar to that, they get to expense a hell of a lot of that. And they can pool this across multiple businesses. So through third-party providers. So if they might work with a local childcare company and use those expenses to help offset childcare costs for their employees, they get a big tax benefit at this point. So it's a benefit to say, hey, this is another benefit we're providing. You may have to pay a little bit for childcare, but we're going to subsidize a lot of that for you. And we win and the employee wins as well. In addition to the, go ahead, what?
I was going to say it'll definitely help out.
It was huge.
I don't know how it's going to affect small business, but obviously the larger companies can afford that.
But even small businesses, yeah, like my business where I only employ a couple people, yeah, it's really not going to help me much. But for, let's say, a decent size, a couple, $3, $4, $5 million a year business, that's a big thing for attracting employees. And I think it's going to give employers who are smaller businesses the ability to provide benefits somewhat similar to what bigger businesses are doing. Paid family and medical leave credits, there's huge benefits for that, for providing more of that paid leave time and things like that. So it's going to give businesses the ability to add benefits, especially for not only the mom, but the dad in the case of when they have kids and things like that. It's very business friendly inside this. A couple things we need to watch now, because once again, Congress always does something where there's a bunch of sunsets and basically what I call a dead man switch. So bonus depreciation, R&D expensing, interest deductions, QSBS tiered gains are temporary and they sunset between 2029 and 2030. So what I would tell you is start doing some planning. If you're going to be making investments in your business, if you're going to be building things, if you're thinking about exiting, it's the time to start planning for that before 2029 and 2030, because all this stuff goes away. The childcare paid leave, vehicle tip deductions also in 2028. So all those are things that you just kind of have to be thinking about. There's this one period of time. The tax cuts are permanent, but some of this other stuff isn't, and we need to be aware of that. If you're a business that is using clean energy and stuff like that, a lot of those clean energy credits rolled off as a result of this. So you're not getting the big massive expensing of solar and things like that. I think a lot of companies, some were legitimately doing it to say, hey, we believe we want to have clean energy as part of our package here. I think a lot of them were doing it just to get the credits and everything else, and they could care less one way or another. They just want cheap energy. So a couple things to look at from an action plan standpoint: lock in equipment and R&D deductions, maximize that bonus depreciation, work with your CPA tax planner to make sure that you understand how that works and that you're planning that out over the next several years. Evaluate your financing strategy. So you might look at debt financing, and if we can get some cuts in the interest rates down a little bit, it's going to be even better. Capitalize on the QSBS as well. Use that childcare. Start to look into the childcare and paid leave credits. I think this is going to be big. I think it's also going to be extraordinarily helpful for small businesses that provide this type of childcare to be able to look at how we can provide this maybe to several companies in our area as a package. And then just plan for the upcoming sunsets. Understand when those are going away and then build your business plan. The good thing is it gives you a good 4 to 5 year plan to look at all these investments that you might make during this time period. And hopefully we can force Congress to push that a little bit farther, but we know for at least we know the rules for the next 5 years.
It's a great overview related to small business, even bigger business too.
Yeah, just think there's so many pieces of this.
And I'm hoping small businesses do talk to a professional because they need to get deep in the weeds on a lot of this stuff to figure out how they could take advantage of it, because some of it is retroactive for this year.
Yeah.
Most of it starts next year.
I tell you the big one too. If you're a business that does any kind of R&D work, I mean, it retroactively goes back to 2022, which is massive. So that ability to go back and look at what you've done there and then fast forward back and say, hey, I can, for those previous years, I can go ahead and capture all that stuff. This is huge. Like I said, yes, there's some negatives to this plan, but from a business standpoint, this is probably the most positive legislation that I've seen, or the most business friendly legislation I've seen come out of Congress in 30 years. I mean, honestly, it's designed to help.
The Secure Act
grow.
1 and 2 were pretty good.
Yeah.
One was Trump, one was Biden. There was a lot of positive things in there, but certainly this is much, much wider and deeper as far as it can help out. And that 100% equipment depreciation, that was actually available with Bush, I think in 03 or 04. I remember that very well. And that obviously came back. You can't have that every year, but certainly in order to do some stimulation and buy American, I think it works out pretty good.
And I think especially works extremely well for businesses that are constantly investing in equipment. So let's say that earth moving business. You're not going to buy all of your stuff in 1 year and depreciate it out in 1 year. But if you're constantly having to upgrade equipment and everything else, it's just a fantastic way to really be able to control your taxes, and you control those purchases when you need to make sure that you get a benefit out of it. And what it means is more stable cash flow for these businesses so that they can keep people employed.
Essentially, you're pulling demand forward.
Yeah.
So we'll see. It's good for the short term. Will it be good for the long term? Because they're pulling all the demand forward, then orders will slow down at some point in the future because we got the equipment we need.
Yeah, I don't really necessarily think that is. I think over the next 4 years, it's pulling demand forward a little bit, but it allows you now the ability to go as a business owner. Let's say if I invest in heavy equipment or machinery or things like that, it allows me to plan my purchases to say, okay, if I do this in this year, okay, now I can offset my tax a little bit because I don't want to do this all in 1 year, because then I have all this deductions and I can't necessarily take all those deductions in 1 year. So it gets carried forward or whatever. So I think it gives you a choice and a planning aspect as a business owner to say, okay, here's the big purchases I need to make. Maybe I'll make these this year, these the next year, these the next year. Some of these I might carry forward as depreciation over a period of time. Some of them I might take that immediate depreciation. So it gives you as a business owner a lot of choices versus your only choice is you buy it and then you depreciate it out over 5 or 7 years or 10 years.
I get it.
So like I said, it gives a plan. What it does require though, is it requires a really good tax planner to work with to determine when you do that and to be able to analyze when you do that. And that's the important thing.
Agreed.
Awesome. Thanks, folks, for being on. I hope this helps. I hope you understand a little bit better as a business person what's out there and what you need to know. If you want a little bit more details on this, I'm going to write an article on LinkedIn, which I've done on the other one, on my newsletter, which is called Exit Rich, Retire Free. Go on to LinkedIn, look me up, and I'll have a long form article on this stuff with a little bit more details on it on there. So thanks a lot, and we'll see you guys back here the very next time.